Hello, everyone. I am Antonio Candia, Principal of Financial Innovation here at the Fondo Latinoamericano de Reservas, FLAR, and welcome back to another week of our virtual conference sessions. It is said that in order to understand geopolitics and investing, you have to get geopolitics right first. I feel privileged and honored to be here with Marko Papic, partner and chief strategist at Clocktower Group and author of Geopolitical Alpha, an investment framework for predicting the future, who will assist us in this effort of getting geopolitics right first. Thank you very much for joining us, Marko.
It's a real pleasure. Thank you, Antonio, for the invitation.
And before you begin your presentation, please let us know a little more about your background, including where you have lived and how you ended up here and why you wrote the book.
Yeah, so I was born in Belgrade, Yugoslavia, a country that no longer exists. And I lived in a lot of different places, the Middle East. I finished my high school in Switzerland. I was educated in Canada and the United States. Lived in Quebec for 8 years. I worked at BCA Research, which many of you probably know. It's an independent macroeconomic research firm based in Montreal. And then in 2019, I left and joined an asset management company here in Santa Monica, California, where I am talking to you from right now. And the book, I wrote the book as sort of a bookend on my career as a sell-side research analyst. It's a book that really incorporates my framework for thinking about politics and geopolitics from a market and investment perspective. And so you can think of it as a summary, really, of that part of my career where I was writing research for people in the markets. And it tries to explain that we don't need, to talk to fancy, expensive consultants to get politics right. We as investors can do it ourselves if we just focus on the material constraints that face policymakers rather than thinking about what their preferences are. So to give an example of this, you don't really care who gets elected in an election. What you care about is what is the political context in which that person, that leader faces the future. If the context is favorable, then it's going to be easy for the policymaker to pursue their preferences. If it's not, it's going to be difficult. So that's what the book is about. And now I work on the buy side, so I still write research, but I focus it towards kind of the long-term themes that I think are going to be interesting for investors so that we can launch illiquid funds and private strategies based on this long-term thinking.
Oh, fascinating. And now if you could walk us through these three macroeconomic and geopolitical paradigm shift that you believe will affect investors through the 2020s, please.
Okay, super. Well, thank you so much for the opportunity. I'm going to spend a little bit of time here talking. What I want to say is that this is a pretty long presentation. It has 63 slides. We're not going to go through all of them because I think all of you will be extremely bored if I did that. So I'm going to just look at the highlights. I want to talk about three big picture paradigm shifts and how they interact. And then I'm going to take a little bit of time to conclude into what I think this means for Latin America, which I'm actually quite positive on. Despite the recent political moves, I actually think that Latin America is probably one of the regions that will navigate these paradigm shifts the best over the next decade. The first paradigm shift that I want to spend some time talking about is really one that's much more focused on US politics and has to do with domestic politics in the US. The reason it's really relevant for you in Latin America and for everyone in the rest of the world is that the dollar underpins our global asset allocation. Whether you're sitting in Santiago or you're sitting in Seattle, ultimately you have to make decisions based on where the dollar is going. I call this paradigm shift the Buenos Aires Consensus, which, if you're from Argentina, no offense or anything, I had to pick a name, and so I picked Buenos Aires. Why? Because fundamentally what I'm trying to say is that the Washington Consensus, which is a set of best practices that we've experienced as investors since the 1980s, since the Ronald Reagan and Margaret Thatcher revolutions. That set of best practices is dissipating. And what I mean by this is specifically that deregulation, privatization, free trade, counter-cyclical fiscal policy, and orthodox independent monetary policy are all eroding on the edges. We are asymptotically approaching some sort of a Buenos Aires consensus rather than the Washington consensus. Now, I don't mean that we're going to have hyperinflation. I don't mean that we're going to have extreme profligacy and populism. I just think that on the margin, we're moving away from the state of affairs of the last 40 years. And I guess the critical point that I want to make is that the United States of America is moving far more towards the Buenos Aires consensus than any other developed market, any other OECD economy. And this is obviously controversial because what I'm telling you is that the United States will be more populist than Italy, than Spain, than any other country that one would imagine as a sort of a populist economy. And the first chart I want to kind of walk you through here is a chart that all of you already really understand. This is nothing new to you as investors, as economists. It basically shows you the top 10% income share of total income by country. As you can see, the United States of America, that's where the top 10% capture the largest portion of the economy, about 45 to 50%. United Kingdom is below, and then France is there at the bottom. Many of my American clients would say France is socialist. As a result, you can see it only captures about 30% of GDP. Now, you know this, I know this. I'm adding no value by showing this chart. But what I'm trying to show here is that things change, things evolve. Countries move up and down in terms of how they redistribute wealth. And what's interesting to me on this chart is that if you look at the 1950s and 60s, in the 1950s and 60s, it was France and the United States that were the most laissez-faire, that redistributed income the least. The United Kingdom, in fact, was languishing at levels of redistribution that even are more significant than France is today. And then something happened. In the 1960s and 1970s, France became what we consider France today. The United Kingdom and the United States went the other way after the 1980s. What's interesting about this is that France underwent this transformation. The purple line went down. So the share of total GDP that was accrued to the 10% of income share went down significantly in France from about 1968 to 1980. This happened because of domestic political risks in France. In particular, the May 1968 revolution in France was a very significant event. It forced the center-right Gaullist government of Charles de Gaulle, Georges Pompidou, and Giscard d'Estaing to proceed to pursue redistributive policies. And by 1980, France was where it is today, where most people kind of think of France. By the way, the socialists in France were elected in 1980, not in 1968. They were elected at the end of this process. Now, there's a couple of things I want to emphasize here. One, the median voter is the political price maker in the political marketplace. Politicians are simply price takers. Center-right, pro-capitalist, Gaullist politicians in France underwent the redistribution that produced this outcome, not socialists. And I feel that investors, particularly in Latin America, I would argue that investors often overstate who's in charge. I speak to my Brazilian friends all the time. There's a lot of hair being pulled in the region over potential return of PT to government. And I think this is a big mistake. The median voter determines outcomes, not people in charge. That's the first thing I want to emphasize here. The second thing I want to emphasize is that I believe that the United States of America is now proceeding with the same type of redistribution that we saw in France. The reason for this is that in the developed world, the United States of America sits in the most dangerous quadrant. So this here is the Gini coefficient on the bottom, measure of income inequality. On the y-axis is the generational income mobility. How likely are different members of the generation to move up and down in terms of income, in terms of wealth? As you can see, the United States of America is basically the worst in both measures of income inequality and, ironically, for the United States, which prides itself on the ability to move up through different social strata, it actually performs the worst on generational income mobility as well. This is a politically unsustainable state of affairs. It has led to violence and unrest in 2020, and of course on January 6th, 2021, where the capital of the United States of America was stormed and 5 people lost their lives. And it will continue to create political risks that will see American policymakers continue to pursue unorthodox monetary policy, and profligate fiscal policy. Now, this is exactly what happened. I've had this forecast for 2 years. This is nothing new. And then, of course, we got the pandemic. The pandemic produced the largest fiscal and monetary policy response we've ever seen before. On the left-hand side, you can see that the increase in budget deficit during this recession dwarfs the previous 5 recessions. And the response in terms of Fed holdings of US Treasuries, so the amount of treasuries bought by the Fed in 4 months during this recession is almost double the 10 years under Bernanke and Yellen. Now, I think the biggest mispricing in the markets today is that most investors look at these charts and they say, Marko, this has to do with the pandemic. This has to do with the COVID-19. It's not a sign of some deeper paradigm shift from the Washington Consensus to the Buenos Aires Consensus. And I would argue that that's wrong, and it will be proven wrong going forward. One thing that I think is very dangerous is that currently many investors have lost faith in further fiscal policy. As you can see on these 2 charts, this has happened before. The purple line is the 10-year Treasury yield. The blue line is the budget balance, cumulative revisions to the budget balance. In 2017, very similar to today, investors doubted the ability of President Trump to pass the fiscal tax cut plan in 2017. As the cumulative revisions to the budget balance went sideways during this period of doubt, so did the 10-year yield. When investors realized at the end of 2017 that President Trump could actually blow out the budget deficit to pass tax cuts, so did the 10-year. I believe that we're in a very similar situation today, where investors don't think that American policymakers can get a deal on fiscal plan, and therefore the 10-year has sort of moved sideways until September sell-off. And I think that is a mistake. There is more fiscal stimulus coming, and I think it's going to be quite meaningful. The reason that's happening is not because Biden is in charge and Democrats are in charge of Congress. It's happening because of where the median voter in the United States is. On the left-hand side, you can see that percent of respondents who say deficit reduction should be a top priority has collapsed. That's very interesting because what's also collapsed is the budget balance. In other words, in 2011, 12, 13, as the budget deficit of the United States was improving, the number of Americans who were concerned about budget deficit was ironically very high. That ushered in the Tea Party, that ushered in the austerity of the past cycle. We have basically no demand for similar policies today. On the right-hand side is a very important chart. It's a chart that Pew Research has been producing since the 1970s. It shows the preference for small government minus big government in the United States of America. As you would imagine, given that this is the United States of America, the net preference tends to favor small government by quite a large proportion in the early 1990s. But notice what's happened. Over the course of the Obama, Trump, and Biden presidencies, the net preference for small government is now lower than the net preference for large government in the United States. What is my point? My point is that we're overstating next year's fiscal cliff. We're understating the political zeitgeist. If you think about why we had disinflation, if you think about why we had secular stagnation in the last cycle, sure, there was household deleveraging, which I think is extremely important and is over, by the way. But the second reason is fiscal policy. Fiscal policy in the last cycle was negative for growth. The G in the GDP equation detracted from growth for basically 5 years. You can see that here. We had a long, drawn-out, policy-induced fiscal drag on growth, which was the product of the Tea Party pushing President Obama to cut spending. That is not going to happen this time around. Obviously, we will have a very sharp fiscal cliff next year in 2022, but that's a product of math. That's a product of rate of change from 2021. It's not a product of policy. In fact, I would expect that they will pass more spending this year and that you will have actually a persistent, mild, and likely unnecessary positive contribution to growth from fiscal policy going forward. That is a major difference between today and the last cycle. In fact, if I was to compare what today looks like, I would say it looks like the late 60s, early 70s. It was a period during which inflation was bid up by precisely the similar policies, in particular fiscal profligacy, of the late 1960s due to political risks in the United States. There was the rise of the baby boomer generation, which caused protests, generational change. There was the anti-war protests of the 1960s and 1970s. And there was a pretty violent reaction in the United States to the civil rights movement of the late 1960s. The American government tried to douse these political risks with profligate fiscal policy and loose monetary policy, which produced the type of an inflationary response that you would expect. Of course, the Fed actually countered to this. The Fed was not behind the curve, as many think, pre-Volcker. The Fed was raising rates, as you can see on this chart, and actually produced the 1973-1975 recession. That recession happened basically before the oil embargo started. So if you think about the 1970s, and if you think about the inflationary era, it wasn't OPEC and it wasn't the oil embargo that caused the inflation. What happened was that the 1960s produced the type of fiscal and monetary policy responses due to domestic political pressures that caused inflation to go higher. Now, today, the Fed is arguing that inflation is transitory. Obviously, I agree with that to some extent. Much of the demand that we've seen so far is ridiculous and is driven by fiscal policy and household balance sheets. Look at the chart on the left. It is absolutely crazy, if you will. It shows that in 12 years after 2008, durable goods spending in the United States rose by $500 billion in 12 years, from 2008 to 2020. In 12 months after the pandemic, spending on durable goods went up by $1 trillion. That clearly is transitory, and it's something that the Fed can deal with mere interest rate increases. The problem, however, is that if the Fed raises rates and induces a recession, like it did in 73 to 75, it will not help the secular supply issues that are building up in the world. The first of those is the outcome of the US-China tensions. We've had, of course, tariffs raised. We've had kind of a peak of globalization, as you can see here on the left-hand side. This is our trade globalization proxy, which basically began to roll over before Trump, before the trade war. And then on top of that, you had tariffs. The problem with US-China tensions is that it creates a national security prerogative for creating redundant supply. In other words, supply chains, which were finely tuned by the introduction of China into the global supply chain, are now being rewired. By itself, this is not inflationary. By itself, the trade war is something that our world can digest. We can still have a disinflationary context, even in the context of a trade war. But this is not the only paradigm that is occurring. Another paradigm that's occurring right now is, of course, the green transformation. The capex necessary to rewire the whole planet is going to be gargantuan. Goldman Sachs estimates it at $6 trillion a year of capex by 2030. IRNA, which is the International Renewable Energy Association, estimates somewhere around $130 trillion necessary to make this happen by 2050. Meanwhile, very little capex is going into fossil fuels, which is causing price spikes, as you can see with what happened this year with natural gas in Europe. So it's not just national security that's creating supply problems. It's also the green transformation. And all of this is happening in a macro context of very little capex. So you can see on the left-hand side that over the past decade, for much of the past decade, the capital expenditures, capex, by commodity mining companies has been very low. Why? Because prices went down. You could basically show oil prices or CRB index nicely kind of, circled around this table. It would look basically the same. Capex in commodities is quite pro-cyclical, and therefore we haven't had enough of it when commodity prices went down. In other words, we're trying to rewire the whole planet for the green transformation. At the same time, the US and China are rewiring their supply chains, and all of this is happening in a context of very limited capex for the past decade. That's a solution for permanent price increases, which is why I think that we are in a fundamentally different cycle, one that will see capex. So this here is just a G3, so US, Germany, Japan, capital goods orders. I think we've seen this extraordinary spike. It's coming off, but I think that this will not be a capex-led cycle. This will be a cycle that will see capex lead. The kind of a capex-led cycle that we had in the 1980s and late 1970s to accommodate the problems of oil supply following the Yom Kippur War in 1973 and China's integration into the economy. Now, does this mean that you should expect hyperinflation? No, no. But even in the early 2000s, we had CPI average from 2003 to 2008, it averaged around 3%. And this is my problem with the promoters of the disinflationary thesis. To me, they're as big of zealots as hyperinflationistas. You have basically zealots on both sides. I am merely saying that inflation can and probably will surprise to the upside. Not extraordinarily so, but can CPI measure in the United States of America about 3.5% for the next 5 years? Why not? I think it can easily do so, especially when we consider that the biggest reason we had disinflation in the last cycle is not population growth, it's not demographics, it's not technology, it's not Uber, it's not even fiscal policy that I just talked about. It was this chart. Credit to households as percent of GDP. The United States of America, which is the red line up here, basically saw deleveraging in the household sector. Households in the United States just said, hey, we're going to take a break for a decade. And growth became completely leveraged to China, which you in Latin America know very well. You could do all of your global asset allocation purely by looking at what? One variable. Total social financing in China was more important than anything. Well, that world is over if the United States consumer is back and if fiscal policy is not a drag on growth. What does that mean for you and for everyone else in the world? It means that the most important question now is how orthodox is the Fed going to be in light of these inflationary pressures? Right now, if you look at the performance of oil prices and the way that the yield curve usually acts when oil prices go up, we are currently in a late stage cycle environment. The dollar is rallying, and also what's rallying are commodity prices. It's usually a sign that the Fed is about to kill the cycle in the next 12 months, give us a recession. In other words, commodity prices, copper, oil, should be coming down momentarily as the Fed responds to higher inflation. I don't think that's going to happen. I think that the Buenos Aires Consensus forces policymakers in the US to emphasize nominal GDP growth targeting rather than fight inflation. And I think you will start to see a pivot in the Fed language towards the non-transitory nature of inflation, but more its supply side nature, something that they cannot fix with high interest rates, which I think is correct, they can't. Watch also very carefully what happens to Jay Powell. As you can see on predicted, his probability of being reappointed has fallen. Everybody expected his reappointment to happen in September. If he's not reappointed and you have a wholesale change in the leadership of the Fed, I think he will entrench this kind of a dovish pivot. Ultimately, the world I think we're going to face is one of hydrogen, high inflation, high growth kind of a world. It's a world that the Fed will usher in by allowing fiscal policy to lead growth higher and by allowing monetary policy to let inflation run a little bit hotter over the next couple of years. Why? Because ultimately you cannot have supply side responses to national security prerogatives and to the green agenda. You can't have supply side responses if you're raising hikes and raising the cost of capital that will be needed to spend all the trillions of dollars of capex that those transitions, those paradigm shifts require. Ultimately, don't forget, raising interest rates ahead of the 1973 recession, causing the recession from 73 to 75, did nothing to address inflation. Inflation came back from 75 to 80, not because of oil embargoes, but because capex was delayed by 2 years when the Fed caused the recession. What does all of this mean? It means for you in Latin America, but really everyone else, if we are in this high growth, high inflation environment, S&P 500 returns should be okay, not as good as in a high growth, low inflation environment, the Goldilocks, but EM returns will be quite well. And so that is a puzzle that's puzzled me and many other macro strategists, why emerging markets have not followed FX and equities with the commodity prices. I think that they're that global investors remain skeptical that we are in a new cycle, and so they have delayed the actual bets on emerging markets going higher. But I think that this is a coiled spring. Look at copper prices, for example, and Latin American currencies. There's a huge alligator jaw chart developing with a divergence between commodities and EMFX. And I think it will snap higher as the dollar goes lower. Obviously, bonds are not a buy in this situation. In a high growth, high inflation environment, bonds don't sell off massively, but they do sell off. Finally, the thing to watch is really the dollar. As I said, right now, the dollar is buoyed by Fed rhetoric. Both the June and the September FOMC meetings basically convinced investors that Marko Papic is wrong, that we're not in the Buenos Aires Consensus, that we're in a Washington Consensus where the Fed reacts in an orthodox fashion. That's what I think took the DXY from 89 in May to basically 94 in October. But the DXY has struggled to break through this kind of a 94 basis. And I think that it will break further down if the Fed either has a dovish pivot or maintains its current level of hawkishness in face of stickier than normal inflation. So that's the first part of the kind of paradigm shifts. It has to do really with US politics and the mounting political risks. Notice that obviously this is a very important point to make. Populism is not happening everywhere at the same level. It's happening in the US as far as the OECD is concerned at probably the highest level. That's why this is particularly a dollar story. And I think that the performance of the dollar in the back end of 2021 is unsustainable if I'm correct that the Fed is going to allow inflation to be slightly higher. Now, the second paradigm I want to talk about really quickly is the Cold War, China-US, and what it means for investors. I think there's a lot of emphasis on this topic, and I think most investors don't really understand where it's headed. I think the term Cold War is being overused and it's overemphasized, and I think it's a really lazy analogy. I think a much better analogy to a Cold War is pre-World War I and pre-World War II era, a multipolar context. Notice that trade between enemies in both historical moments was actually quite positive. So the trade between France, UK, and Russia with Germany went up right up until the war. And the trade between Japan and the United States also increased. Now, in both cases, countries were very much aware that a war was coming. They were very much aware that there was a geopolitical risk, and yet they continued to trade. Why? Because allies don't trust each other in a multipolar context. So in a multipolar context where there's no one or two countries that kind of lead the world, where it's every country for itself, it's very difficult to create alliance structures that keep trade to a minimum. You can see that actually with a stark example today. Australia, which is kind of the West's tip of the spear against China, went out in 2020 and was quite aggressive towards China, asked for a COVID-19 investigation, and China imposed embargo against Australia. As a thanks for its standing up to China, the United States of America has taken all of Australia's trade with China. So instead of backing its ally up by saying, hey, Australia, we're not going to take your market share in China because you stood up for the West, the United States came in and took all of the trade. This is an environment in which you should not expect a coordinated policy response to China. It's going to be very, very difficult to have a coordinated policy response because allies don't even trust each other. And if you look at, for example, the view of China in the US in Europe, in many countries, in most countries, China has a more unfavorable view, but it's pretty close. It's not that clear that most Europeans favor China or US over China. That's why you should expect there to be some splinternet, some decoupling, some bifurcation, but it's not going to be dramatic. What I'm thinking is that we will have a return to the 1980s, 1990s level of globalization, which was still a globalized world, but there were technological standards. For example, I grew up in Yugoslavia and I grew up in Europe, and it was impossible to watch VHS tapes that my relatives from the US sent me. Many of you in Latin America probably remember this era as well. That was the Pulse Secom NTSC kind of a split. Or the chart on the right. When I left high school in Switzerland and came to Canada for my undergraduate degree, my cell phone didn't work. That's the world we're going back to. Is that a world that you should be afraid of? Of course not. It's actually a great world to invest in. So one of my main investment theses for the past 2 years, since the trade war started, is to invest in capex goods. In this particular case, this chart shows you the performance of our capex, of our semiconductor capex index, which is the purple line. These are companies that help semiconductor companies build their fabs. In a world where national security suddenly matters, you will see an overproduction of goods because of national security redundancy. Countries will want to have redundant supply chains. And that will benefit capex companies. It will also be reflationary and inflationary in the short term. In the long term, we'll have too much stuff produced by too many countries, of course. But from here to there, it will require commodities to build out those fabs and to build out those redundancies. Now, in terms of China itself, my sort of neat geopolitical thesis will be scuttled if China invades Taiwan, if China decides to militarily reunify Taiwan. In other words, the ability of allies to coordinate and have an alliance structure will be much simpler if China is aggressive. It will be much simpler for the United States of America to convince its allies to go with it. So I want to spend about 2 minutes explaining why I don't think China will do anything aggressive over the next 5 to 10 years. First and foremost, China's biggest problem, its biggest constraint is its geography. A lot of investors or geopolitical strategists talk about the first and second island chains that China is trying to occupy or conquer. This is a mistake. The number one critical points for China is the Malacca Straits and the Straits of Hormuz. Straits of Hormuz is becoming even more important for China because over the past 5 years, China has become addicted to Middle East supply of energy. In other words, China can attack Taiwan. It can militarily reunify with its wayward province. That can definitely happen. The problem is that if it did so, it would be without oil if the United States of America imposed an embargo in the Straits of Hormuz. There is no way for China to defend the Straits of Hormuz. It doesn't have the Navy for it and will not have a Navy for it over the next 10 years. Not only is the Straits of Hormuz far away from China, not only is the American Fifth Fleet present in Bahrain, but China would also have to circumnavigate its dear friend India to get to the Straits of Hormuz. In other words, it's not happening. That's the first constraint of China. The second constraint of China is that the Chinese economy is slowing down. And China is increasingly becoming mired in what I call, well, what many call the middle income trap. This chart shows on the bottom, on the x-axis, GDP per capita as percent of US GDP per capita. Y-axis is GDP growth. As you can see, the East Asian economies of Taiwan, South Korea, and Japan, the light blue, escaped the middle income trap from 1955 to 2021. Latin American economies, which is the gray, have been stuck like a wheel spinning in the mud, stuck in the middle income trap. China is obsessed with this issue. If it becomes mired in the middle income trap like Latin America, it will experience the type of political changes Latin America experienced from 1955 to 2021, which means a lot of changes in regimes, coups, and all sorts of instability. China does not want to experience that. But given the deceleration of growth due to demographics and other issues, China has no other choice but to pivot towards more redistribution, towards more income inequality so that it can prepare for a life in the middle income trap. And as it does that, it's going to become more and more dependent on exports, not less dependent on exports, as it hopes to do. So you can see on the chart on the left-hand side, you can see that exports have become the only source of growth. That's the light blue line. From 2020 to 2021, last 2 years, exports have become the only source of growth in China. And that's no doubt because unlike America, which deleveraged its consumers last decade, China leveraged its private sector. Chinese consumers, Chinese domestic consumption is going to be weak for the next decade. And if its domestic consumption is weak, then how is China going to pivot away from exports and investment-like growth? They just won't do that. The second issue that's a problem with China is demographics. I don't have to go over charts that show weakness of demographics in China. You're very well aware of that. Everybody is. But the reason this matters is because as household saving goes down, as demographics go down, as a country ages, its household saving goes down because all people don't save, they consume. People between 45 and 65 save as their incomes go higher. So as China ages, its saving rate will go down. However, China, given the slowdown in growth, doesn't have the luxury to drop its investment rate. You will have to keep investment rate high. What happens if your savings goes below your investment? You get a current account deficit. And that's what China is already flirting with. In 2018, its current account almost dipped into a deficit. China, in my view, over the next 5 years, will dip into a deficit on the current account. Why is this important? Again, most of the audience here is Latin American. You all know what happens if your current account is in deficit. You become addicted to foreign capital flows to balance your payments. And if those foreign capital flows disappear, you have a classic balance of payment crisis. China will experience such a crisis if it decides to be geopolitically aggressive. And that's why I don't think that China is going to be aggressive over the next 10 years. It's trapped by the geography and by Straits of Hormuz and its addiction to foreign sources of oil. It's going to be increasingly more addicted to foreign sources of demand and increasingly more addicted to foreign sources of capital. What does this mean? It means that if you're an investor, there are interesting investment opportunities in China. In particular, we like semiconductor companies and solar companies. Anything that has to do with the alternative energy, EVs, green technology. China is emphasizing that because it's its only way to become more independent. And semiconductor companies, obviously, that's also important for August. But a war between US and China, I wouldn't expect it. Now, I don't have much time for the last paradigm shift, which is fine. It's actually quite simple and obvious in terms of implications for investors in Latin America. It has to do with the race to zero, this concept that we are currently experiencing a real emphasis on green transformation across the world. Obviously, we had a summit in Scotland, didn't really go anywhere. But what's important is that policymakers across the political spectrum are starting to really focus on the green transformation. What I want to talk to you about is that this is irreversible. In my view, this is the #1 investment thesis for the next decade, more so than crypto, more so than metaverse, more so than anything else. The #1 investment thesis over the next decade is going to be the shift towards a green transformation. But it's happening not because Al Gore and Greta Thunberg told us it's happening. It's not happening because we actually care about the planet. It's happening for 3 reasons. First and foremost, the technologies that underpin the green transformation are here, and the transformation in technology is real. It's legitimate. Alternative energy, costs of alternative energy have collapsed in just 10 years. Cost of batteries have collapsed. The technological innovation follows Moore's law in alternative energies. So the first issue is that technologies are legitimate and they exist. The second issue is this macro policy, the policy of the Buenos Aires Consensus. What does that have to do with the green transformation? Well, if you're going to generate nominal GDP growth, you need to break a lot of windows, to use the Keynesian thesis. So the green transformation, the re-electrification of the planet, becomes a jobs program. And that's why if you look at the right-hand side, the global green initiatives pledged so far basically dwarf any other major project we've ever done as humans, including the US interstate highway system or the things like the Apollo program. Also the Great Wall of China, by the way, if you're interested, which is kind of hilarious, although my team did not find it funny when they were trying to inflation adjust the Great Wall of China cost of building. The bottom line is that the impetus to generate growth makes it easy for policymakers to commit to these green initiatives. The second issue is geopolitics. As I said, China is increasingly addicted to foreign sources of oil. It needs to find a way to set itself free of the Straits of Hormuz. Can invade the American Navy. It could do that. That doesn't seem like a wise thing to do. Instead, it is going to build up its EVs and batteries technology. Also, as China comes to dominate batteries and EVs, it creates an incentive for other countries, because of national security redundancy prerogative, to build up their own capacity. So there's a geopolitical component to the green transformation that makes it quite sustainable. What does this mean for investors? Very quickly, in terms of what it means for investors, 1, invest in mining. 2, invest in green stocks. 3, invest in industrials and energy over IT and communication. 4, do so in the private space in particular. And 5, productivity will rise over the long term. This will be disinflationary. But in the short term, as we're rewiring the whole planet, this will be inflationary. Finally, what does all of this mean for Latin America? Well, I think what all of this means for Latin America is that ultimately we are entering a commodity supercycle. And I think that that's a really good thing. Unlike the previous commodity supercycles, Latin American currencies are entering this commodity supercycle at very cheap valuations. If you look at, for example, Mexico's real broad effective exchange rate, you can see that Mexican peso is extremely cheap relative to both other EM exporters and relative, most importantly, to China, which is really important because from 2000 to 2012, Mexican peso was actually quite expensive. So not only are currencies in emerging markets cheap, especially in Latin America, but also so are the equities. If you can look at 12-month forward PE ratio, Latin America is by far the cheapest relative to emerging markets, global, and so on. And yet real GDP growth is on an upswing. So in my view, if you look at this chart on the right, this is a real investment opportunity, not just for you in Latin America. In fact, actually for you in Latin America, it may not be that interesting. But for the rest of us around the world, when we look at this chart, it means that something is going wrong. The market is basically ignoring what's happening to commodities, assuming that the Fed will somehow end the cycle prematurely, even if that brings up a civil war in the United States of America. Latin America versus EM Asia equities are extremely cheap. And I think that the performance of commodities will lead those assets higher. That's why we at Clocktower actually created a specific fund for Latin America. It's focused on fintech, and we continue to think of ways to leverage ourselves to the region. Okay, so I'm 4 minutes over time, which I think is not bad given that I had 63 slides. So thank you so much, and I'm open to Q&A.
Thank you so much, Marko. Well, once you mentioned this very interesting thing about Paul Volcker, and to say that there is no way that an academic could do this by only being competent. And it was the medium voter that was okay with this. So what do you think is the role for institutions, supranational institutions in the Buenos Aires Consensus?
That's really putting me right on the spot there, Antonio. You know, I think central banks are independent in the short term. I think that's clear. But in the long term, we know that central banks don't really have independence, and never did. And that's because the appointments to the central banks are made by politicians. So over the course of 2 to 3 years, during a political mandate of a leader, they can use appointments to change kind of the trajectory of the central bank. And you know, this doesn't happen in populist countries. This happens in all countries. Think about Axel Weber, for example, who was, you know, supposed to be the next in line for the ECB. He met with Angela Merkel in 2011, I believe. And in this secret meeting, nobody knows what happened. But I assume that Angela Merkel asked Axel Weber if he was willing to buy Spanish and Italian debt. He probably said no. She said, okay, well, I'll find an Italian who will. And then he resigned from the Bundesbank the next day. So what is the role of you know, institutions? It's going to be kind of whatever the policymakers really want. And I mean by that, really politicians. I think what I don't want to do is I don't want to give you a should answer. I have no view on what should happen. I'm just giving you a sense of what will happen. Now, I think the audience right now might really disagree with me for good reason, and I hope you do. I hope that most of you disagree with me. But I think that over the longer period of time, it is just going to be very difficult to move against the political zeitgeist. And we obviously saw that with the Fed, with the average inflation targeting regime, with some of the statements that premature tightening in the past has caused undue pain for the median American, which is almost verbatim quote from Leo Brainard, who I think might succeed Jay Powell. So there's this more of an emphasis on different types of employment, different minorities in their employment. And I think that with these supply side issues driving inflation higher, I think it'll be easy to make an excuse for why inflation will be allowed to be high. And here, I don't want to use the term should, but I will say that it's not crazy, it's not wrong, it's not insane to focus on the supply issues and the capex requirements of this massive green transformation. It's not necessarily incorrect. It's not just an excuse that central banks will use to keep interest rates lower than they probably should.
Our following session will be about CBDC, and you mentioned a lot of things about the US dollar and what lies ahead for the dollar as the dominant reserve currency. China wants to de-dollarize the Belt and Road initiative. They are going to be the first launching a CBDC. So how do you think this could evolve?
Well, I would love to listen to the next session so that I can get the answer. I will just say this. I think that China being the first in adopting sort of a sovereign cryptocurrency is important. I think it will allow them to have some innovation in monetary policy. We all know that this will potentially allow central banks to get much more granular in the imposition of interest rate policy, for example. In fact, having multiple interest rates for multiple actors might be a possibility with the adoption of currencies. But I think that the bigger question is, what is the alternative to the dollar? And for the most of the last decade, I've always said none. You know, for the past decade, I've been very skeptical of the view the dollar could kind of erode. But I actually think that the euro is rising. First of all, in terms of global payments, the euro is now caught up with the dollar. I don't know if you've seen the data on this, but it's actually very interesting. And I think one of the things that's happening that nobody's talking about is a break between Europe and the United States. It started with the Trump administration, but it recently has continued with the Biden administration. So the nuclear submarine deal that was scuttled for France by the United States is really, really significant. That was 2.5% of French GDP. The equivalent would be if France undermined a $567 billion deal for the United States of America. This is big money at play. And the United States basically chose not to incorporate any EU member state in its containment of China. Why is this important? Well, if you're running a country like India or Brazil or Mexico or Pakistan or Iran or Egypt or any other major economy that's kind of a third way, non-aligned, you're probably going to want to use the euro as a sovereign debt hedge and also as a payment system. Why? Because Europe is emerging as this third entity, not because of growth, mind you, not because of power, just because it hasn't collapsed, very low threshold. But that is allowing many actors, whether sovereign or private, to diversify their exposure to the US dollar.
One of the main takeaways of your framework for me has this that politicians are price takers and not the price makers. So through these lenses, is there a risk that there could be an exception, like to this rule, like to suppress the medium voter, like for example Afghanistan or Cuba? What do you think about it?
Of course. My framework really is focused on the investment relevant world. And so the reason that we're interested from an investment perspective in economies is because they have something to offer. And that usually means that they're growing fast, that the middle class is rising in power, and that as such, it's very important for policymakers to kind of respond to the middle class. So while I think your examples are very correct, Venezuela, Cuba, Afghanistan, many other countries, ultimately, policymakers try not to steer clear of the median voter. A good example that I talk about in the book is China. Does China have a median voter? Well, of course, it doesn't. I mean, there is no voting. But if you actually go back and look at every single policy that Xi Jinping has implemented since 2012, since coming to power, every single one of them was tested in the social media and was basically done to satisfy the rising middle class. Every single one. Anti-corruption reform, middle class wanted it. Anti-pollution, middle class wanted it. Anti-SOE policies, middle class wanted it. Lowering real estate prices, middle class wants it. Literally every single thing that Xi Jinping has done was basically focus group tested in social media and in various internet kind of chat rooms, if you will. So I think that that's a very important point. Policymakers always adopt policies that the median voter wants. The reason this is important for us as investors is that we overstate who wins elections. And this is, by the way, the case in Latin America more so than in any other region. And I'm not saying that Latin American investors themselves make this mistake, although I think they do. But I would say that we in the West and in the rest of the world even emphasize who gets elected in Latin America more. But if you actually see performance in Latin American assets, it really doesn't matter. What matters is whether you're pre or post current account balance of payment crisis. That's the only thing that matters. So Karl Marx himself could rise from the grave, become president of Brazil. But if the currency is cheap, if the current account is in a surplus, and if commodities are going higher, Brazilian assets will outperform.
Now, I get a question from the audience, and it says, doomsayers write off the United States going forward, and inevitably the ascent of China substituting the US as the dominant power. What would you say to this?
No, I think China is at peak power. I would actually say that if China wanted to militarily reunify with its wayward province of Taiwan, it could have done it easier in 2011, when it was less addicted to Taiwan, to foreign oil, when it was far more capable from a domestic consumption perspective to ramp up its consumption domestically. So I don't think that China is really a major threat to US power, but it doesn't mean that US is at the same level of power relative to the rest of the world that it was 10 or 20 years ago. In other words, in relative terms, US power is either flat or coming down. But the biggest risk, I think, to the US is not really challenged from Russia or China. The biggest risk is what I talked about, which is this income inequality and political risks domestically. That can cause an overly populist response, and that can erode the power of the dollar, and that can erode the efficiency of the US economy. So I would argue that the biggest risks to the US are domestic, not foreign.
It's funny that you mentioned Marx, and as I recall from my high school reading of Karl Marx, yes, reading Marx in high school, that was a thing in Bolivia, where I am from 20 years ago. When the means of production conflict with the mode of production is when you got this revolution. Is that revolution this race to zero? How do you see this?
Yeah, that's a great way to put it. I mean, that's exactly how I put it in my research. I didn't really go over this, but there was a slide that I skipped over that talks about that I see this in the Marxist terms of means of production being changed. And I think that we're moving away from industrial scale means of production. For the last 400 years, Antonio, I see the means of production as those that allowed us to scale everything. You know, men with guns. We scaled humans who can read. We scaled medicine. We scaled iron. We scaled railroad production. Everything was increased. I think going forward, the means of production are changing. They're allowing us to produce goods and services for the tail of distribution, not for the median. And I do think that this will cause a lot of dislocation, and I think it will cause, both political risks and also great opportunities for human race. Like, I do think we will eventually solve climate change as a problem because of this technological innovation, but it will be pretty turbulent. In the near term, what is the main risk to me? I think the main risk to me is just that we're rewiring the whole planet. That's going to be expensive. That's going to cause a lot of commodities to go through the roof. And you saw the yellow vest protests in France, for example, which was sparked by an increase in gasoline prices. You saw what happened in Chile with a very, very minor increase in metro costs. Obviously, there were other issues that underpinned that protest. But I think that we can see that the cost of this transformation is going to cause a lot of people to lose faith in institutions and policymakers.
I know that you're a basketball fanatic, and sport analytics have changed the game. Social media has accelerated investment narratives. How do you navigate this without freaking out with a few tweets? You mentioned that you have to avoid being a human of getting this right. Do you think machine learning, AI tools, that algorithms encourage us to polarize, to read only the things that we want to read? How do you think in terms of incorporating this through your framework?
Wow, there's a lot of different questions in one. I like that. Here's what I would say. First of all, going back to your first comment, which I cannot just let slide, I am a huge basketball fan. And what I will say is that it's a really good example of how overly using AI and machine learning is a problem. For those of you who are basketball fans, and I'm sure there are some of you, one of the trends in NBA is an emphasis on three-pointers and layups. No more mid-range jumpers. Why? They're inefficient mathematically. The problem with this that in a playoff game, that's the only part of the court that's open, And so teams that retain the ability to hit a mid-range jumper suddenly have an emphasis when it comes time to winning. In other words, the problem with AI and algorithms and machine learning and all this stuff is that it's only looking at a limited data set. And it doesn't necessarily tell you what's true innovation. Like Henry Ford famously said, if I had asked the customer what they want, they would have said a faster horse. In other words, if you're using incredible AI and incredible quantitative tools to gauge insights from a particular data set, the positives, the usefulness of those conclusions will be only as useful as the quality of the data set, which may be limited. And that's what is example with Twitter and social media. Yes, it's becoming more polarized, but what I would say is that what's becoming more polarized are people who use media and social media intently. And a large proportion of votes don't. A large proportion of voters don't actually sit on Twitter all day. As my favorite comic Dave Chappelle said, Twitter ain't real life. He added something else, an F-bomb too. But the point is, Twitter is not real life. It's not. That's how Joe Biden wins the 2019 nomination, the 2020 nomination, and the election. Every single political analyst that I spoke with ahead of the 2020 election told me that I was absolutely crazy to think that Joe Biden would win. But two very important constituencies of the Democratic Party, the African-American voters and baby boomers who are elderly, were not on Twitter talking about Bernie Sanders or talking about Elizabeth Warren and so on. So that's, I think, something that investors should also think about as well. The more we use systematic strategies and quantitative tools, the more we're liable to actually face incredible downside risks in times of volatility and turbulence.
Well, anything on your brain right now that you think we didn't cover?
Yeah, I think that, we kind of hinted at it, Antonio. You asked me what are the biggest risks to, this green transformation. I think price increases are going to be a problem, but they're not going to be a problem for the American consumer. You hear a lot of investors out there talking about how the Fed is going to have to increase rates because inflation is going up in America. Like, wait a minute. Like, food and energy is a very small component of the CPI. Like, nobody in America is going to go to the streets to protest food prices going up. That's just that's not the world that's going to happen. In fact, the tight labor market will ensure that wage prices go higher as well, which will keep people happy for the next 2 to 3 years as inflation outperforms. In the long term, I agree. Obviously, there'll be some angst. Specifically, real estate prices are a big political issue in the US as they are in many other places. But look at Canada. Canada should have had 17 revolutions by now, gauging by the real estate prices. So what worries me, Antonio, is not angst in the developed world. What worries me is the angst in the emerging market world. Particularly, India seems as a really interesting country. It's outperformed massively this year. Some of the structural reforms that I've been worried that would never pass, they actually did pass, and it's outperformed the emerging markets considerably. But that's happening in a context where commodity prices are going high, which usually is not good for the Indian economy. And so I worry that the CPI increase in countries where food and energy are a high proportion of the basket, that's where the political risks are going to appear over the next 1 or 2 years.
Marko, what a treat to have this conversation. I hope that we can meet in person next year in Colombia, here in Cartagena. Thank you very much.
I would love that. Thank you so much. Thank you, Antonio.
Thank you.